Hi, I'm Mal from the Money Study, bringing you another episode of our Take 10 Challenge, number 78, all about using a family trust. There's the disclaimer, facts, figures, information in today's session, but it's not advice. Okay, yesterday we were talking about what is a family trust. Now let's try to get our head around a really bit how we could use a family trust to our benefit. So as we sort of indicated yesterday, the flexibility in being able to distribute this income and any sort of capital gains to whoever one of the beneficiaries is by far one of the best uses of a family trust. Because, as we said, the trustee has got absolute discretion when it comes to distributing the trust net income and the capital gains to anyone in the trust. And so therefore they can choose to do it in a way that basically effectively is tax advantageous. So you could distribute your income to your children through a trust. So instead of being you getting the money, and you might be on the highest marginal tax rate, you might be paying 45 cents in the dollar, but your children effectively are only paying tax at say 16% perhaps with the new stage 3 tax cuts. They might basically not even being paying tax. They're earning underneath the 18,200 threshold. But effectively what it boils down to is that money can be distributed to the children. The children, because they're a lower tax bracket, are paying less tax on the money. And of course the money is still coming to the family, and that's the issue here. I mean, it's not like we're just giving our children money. The money is actually just going to the children's names, and of course it can then be, once it's in their hands, the money can be literally moved wherever it needs to be within the family. Now, of course, please note that they did change the rules years ago in relation to children, because effectively a lot of people were using these family trusts to give it to children who didn't even have any income at all. These were minors. These are kids of 6 years of age and so forth. And of course, obviously, that was a bit of a rort where money can go to a child who's only 6. They can't handle money. And so they basically tightened up the rules to say it's got to be a child over 18. So if you've got kids at uni or so forth, it's quite useful. But if you've only got some 10-year-olds and so forth, then not a lot of benefit, because the trust distributions to minors, they're taxed. It could be up to a rate of 66%. So not a lot of advantages in that regard if you're going to be dispersing it to children and pay a higher rate of tax than your own level of tax. So it just comes down to what level of tax are the various different beneficiaries of the trust in. And of course, if there's tax to be paid, obviously putting it in the hands of the one with the lowest income tax rate is obviously going to be smart from our tax situation. But be very careful of minors, children under the age of 18. The asset protection side of the family trust can, say, be useful in the regard that it does give you a degree of protection against some of these assets held inside the trust. Because in most cases, a creditor cannot take a trustee's personal assets in the event of the bankruptcy. So they can look at the trust, but the actual personal assets effectively of that basically cannot be touched. So likewise, creditors can't take assets held by a company trustee in the event of the company's liquidation, subject to, there are some exceptions there. The best part probably about a family trust is it's cheap to set up. It's pretty cheap to set up. It's not like a company, where you've got to go through all the rigmarole of setting up a company and paying ASIC a fee every year for the ongoing government fees and so forth. We don't have any of that involved with the trust. A family trust, however, does have a maximum life of only 80 years, except in South Australia where it's unlimited. But yeah, effectively it only lasts you 80 years, in which case we could obviously then just set up a new trust. But yeah, we don't have this ongoing cost. Companies can be quite expensive to operate in the regard of all the different regulation and compliance applied upon a company to make sure it's solvent and so forth. Be aware, however, that capital losses can't be distributed to trustee beneficiaries, meaning that if you've got an asset that has lost money on its sale, then it would be nice if you could be distribute that to someone in the trust that's got some sort of a sort of a capital gain issue or something in the same year to offset their capital gain. No, that can't be done like that. You can't distribute the capital loss to a beneficiary of the trust. It just literally means that the capital loss is basically offsetting the trust's capital gains in the next financial year. So it can be carried forward to offset any other gains of the trust, but it can't be used to offset gains of individual beneficiaries directly. Okay, so it just literally means that the capital losses stay within the trust, not distributed. Bit of a shame, really. Not ideal for running businesses. I sort of indicated a little bit yesterday. There are several reasons why it's uncommon to run a business through a family trust. Firstly, the trustee will need to distribute any income the business makes to the beneficiary. So therefore, the business itself can't retain the profits. So normally a business generates some profits, and depending on what the business is doing and what it needs to do, it may pay out some of the money to the people running the business, or the business people, the managers can literally just pull out what they need, leaving the rest of the money in the business to be able to function, perhaps to buy some sort of product or something. But in the regards of a trustee, because the money needs to be distributed every year, it means that all the profits of the business would indeed have to be paid out to the beneficiary. So yeah, not really a smart way of doing it. Secondly, the trustee of the trust may personally be liable for the debts of the business, as we sort of indicated, because the trust is not a separate legal entity. So it just comes down to, it's got its uses, and that's probably why most people sort of call it a family trust. It is, I say, it's a discretionary trust. It's a general term, but as a family trust, that's basically what we're looking at. It's more aligned to the uses within a family network. The trustees of your trust will hold the legal title over the trust's assets. So this means that when you establish your trust, you will need to transfer your ownership over the assets to the trustee. So what that meaning is, if you've already got some sort of investment and you want the investment to be put into the trust, then you are indeed triggering a capital gains event. So therefore there would be a capital gains payable quite often, literally just to move it. So you're effectively selling it effectively to the trust. That's effectively what's going on here. So you've triggered a capital gain. It's a change of ownership, and of course it could even, depending on what the actual investment is, could indeed give rise to some sort of a stamp duty or a GST payment or something like that as well. So be careful when you're transferring assets from yourself into the trust. It can indeed trigger capital gains issues and even GST, depending on your status there. Once you've set up the trust, you'll need to consider the time and cost involved in meeting the trust annual accounting and administrative requirements, meaning, yep, there's compliance. Along with any structure like this, it just requires annual compliance to make sure it's all up and running and running as a legal entity there. So it just simply comes down to, most people, what do? Yeah, have an accountant to do what's necessary. I mean, most people just get their accountant to set it up. They'll get their accountant to close it down. They'll get their accountant to run it. And so you can see why probably accountants like these things. It obviously generates a bit of work for them. But don't just dismiss it thinking it's accountants just trying to con you into something because he gets more money. Look at it as the advantages and disadvantages. And it could be a case that there is a period of time where having a family trust is quite useful, in the regard of, say, you might have some 18, 19, 25-year-olds still living at home and at uni, and because you're helping them out through uni, having it through a family trust could be quite a handy way to be actually helping them. so that the money you're paying them is coming from a family trust, and we're reducing tax and so forth. But of course, once those kids are now earning good money and their tax bracket's the same as yours, then really you've got to look at it and say, well, is there any benefit any longer? Could be the fact that if your partner's got a totally different income, that could be still useful. But I say, get to the point where perhaps your partner's gone back to work after raising the children, that they're also on the same sort of tax bracket. The whole point of the family trust has become null and void, in which case you just literally get your accountant to close the trust down. So it's not something you have to keep for 80 years. It just means that you have this family trust while it's applicable and makes sense to do so. The trust itself is governed by the trust deed. And so it's pretty crucial that this trust deed does what we want it to do. And again, this is where your accountant would come into play. Most trust deeds are fairly standard, off the shelf type of things, but your accountant may recognise there's some particular structure of your family that might be able to be utilised if the trust deed was to mention something or do something differently or not allow something. So have a good talk to your accountant, make sure he fully understands your situation, understands your family unit and your network, and let him then come up with a trust deed. And hopefully you can read through it to understand what that trust deed is really indicating, and does it really do the job that you're after. So look, family trusts, not quite as powerful as they used to be years ago, but still they can certainly provide a good benefit for people with the right sort of family situation there. Happy to have a chat anytime. Give us a call, email us there on admin@themoneystudy.com.